Hey there, Brad Casser from GreatOptionTradingStrategies.com. Apologies for not having posted a new video for a couple of weeks, but to be honest, I've been pretty busy inside the Leveraged Investing Club of late. Going into the April monthly option expiration, we actually closed 5 more official club trades, with all of them being winning trades booked for profits. That brings the number of trades we've closed in 2026 for profits to 16, with 0 booked losses year to date. And for 2025, we closed 46 official club trades, with all of them being winners as well. As always, I've got a lot of resources in the description section below, including the 2025 and 2026 trading history if you want to check that out. In any case, I trust this video will have been worth the wait because I want to show you what regular, normal, typical put selling trades for income should look like when you have disciplined trade entries and disciplined trade management processes in place. We'll go over those aspects of the trade in today's video, but even better, I've actually put together a 12-page PDF case study that you can download so you can look at the trade more closely and keep it as a permanent resource and reference guide. And that's in the description section as well. And if you've been following this channel for very long, then you know that I love dissecting real-world trades because I firmly believe that every trade has something to teach us or reinforce in us. So in this video, we'll go over the trade entry, how we managed it when it misbehaved on us a bit, what a disciplined trade exit looks like, and then the 3 key lessons or insights the trade has for us. So let's dive in. Now, the stock we sold puts on was TROW price, and it's one of my favorite under-the-radar stocks to sell puts and covered calls for income on. We actually traded this one 3 times last year and made money each time, of course. Our lowest performing trade was the first one we did, which was back during the tariff sell-off, and we had lighter returns due to repairs that we needed to make, and we booked 11.56% annualized over 67 days. We also had another short put position on TROW back in July that generated 17.68% annualized over 32 days. And at the end of the year, we had a really successful 9-day trade on TROW that resulted in 40.03% annualized returns. Okay, so let's look at the trade I want to talk about today. This was back in early February 2026, and we ended up selling $90 puts on TROW expiring the following month. So let's look at the rationale for the trade. First, there were the technicals. As you can see in this chart, support in that 90 to 92.50 range was holding. And we also got a nice bounce off an oversold RSI rating, which you can see in the upper right-hand corner of the chart. But I felt that it would be the valuation, quality, and dividend attributes that were likely going to put a real floor in the share price. Now, regarding valuation, TROW had a forward PE of less than 10. TROW price is also a dividend aristocrat and now has a 40 consecutive year track record of increasing its dividend, although the more recent increases have been pretty light. But at the time I put together this chart and the original write-up inside the Leveraged Investing Club, TROW had a dividend yield of 5.46%. However, at the $90 share price level where we would sell our puts, that dividend yield would increase to 5.73%. And assuming we could get a couple bucks in premium and assuming a theoretical assignment, that adjusted dividend yield would bump up all the way to around 5.85%. Now, I love situations and setups like this. I call them no-lose trades because no matter what happens, you should come out ahead. If the trade goes according to plan, you get terrific short-term annualized income. And if the trade doesn't go according to plan, you're set up for a tremendous adjusted entry price for a long-term investment in a high-quality stock, should you want the adjusted entry price rather than going the repair route. Okay, so on February 9, 2026, with TROW trading at $94.65 a share, I sold to open a single TROW March 20th, 2026 $90 put for $2.10 a contract. Quick side note, I always enter club trades as a single contract to demo the trade. But inside the Leveraged Investing Club, we have opening position size guidelines to help you determine the appropriate number of contracts based on your portfolio size. Now, after commissions and fees, I collected $208.88 in net premium for a really nice 21.72% annualized rate projected over the following 39 days until expiration. Now, over the next several weeks, TROW steadily drifted lower as the broader market sold off and corrected throughout the month of March. But despite the position trading a bit in the money on us, in other words, the stock fell below the strike price of our $90 short puts, the trade had been pretty boring and there was nothing to do with it until the day prior to expiration. With our 4-stage trade repair formula, we don't manage trades based on remaining time, but rather remaining time value. And because the VIX had been so elevated as part of the nervousness and weakness in the market throughout March, our TROW short puts stubbornly held on to a decent amount of remaining time value until just about the very end. Now, our first choice with in-the-money short puts is to roll down and out to a lower strike. Providing we can get a net credit, meaning we collect more from selling or setting up the new short put position than what it costs us to close out and exit the old short put position. And we also don't want to roll out more than 3 monthly expiration cycles. Anything beyond that, and you're starting to look at very inefficient use of your capital and time. This is what we consider a stage 1 repair, rolling down and out to a lower strike for a net credit without rolling out farther than 3 monthly expiration cycles into the future. Unfortunately, because TROW monthly options are priced in wide $5 strike price increments, rolling down and out from the $90 strike to the $85 strike within 3 months was problematic. There was a borderline moment, however, when rolling down and out to the June expiration cycle, which was 3 months out, did look like it might generate a small net credit, but I ended up passing on that. This is actually one of the lessons of the trade. Even though we have clear, well-established trade repair principles and guidelines that tell us what to do and when to do it, it still makes sense to take everything on a case-by-case basis. So I ended up going with what we call stage 2 repairs, rolling straight out for a net credit. And again, only 1 to 3 months out in time max. So in this case, I decided that I'd much rather kick this out just 1 month to the April monthly expiration cycle and give the stock, along with the rest of the market, some more time to recover from its sell-off. Now here's the deal. The TROW earnings release was scheduled for April 30th, which means the regular May expiration cycle would be exposed to that earnings release. Earnings releases are a double-edged sword. Unless there's a very special situation, we never enter a new trade if it's going to cross an earnings release. But if we're already in a trade and we need to, we'll use the earnings calendar and the extra premium boost from impacted options to help repair a trade. I've also added a link to a video in the description section below where I go over this in more detail on an Academy sports trade that we successfully repaired with the help of an earnings release. But as it related to the TROW trade, rolling straight out to the April expiration made a lot of strategic sense. As I said, it gave the stock another month to recover, brought in additional net premium at a really attractive rate, and it did not expose us to an earnings release. And if the stock didn't recover, or only partially recovered by the time the April position was set to expire, well, we still had that May expiration with the earnings-related premium boost on our next roll. And maybe this time we'd be able to roll down and out to a lower strike for a more solid net credit, although we'd probably have to go out another month or two beyond the May cycle. Or if none of that was possible, we'd still have another straight rollout for a third round of premium at a really attractive rate. And again, remember, I consider this to be a no-lose trade. If the campaign continued and brought in a third round of net premium, my potential adjusted cost basis would just be going lower and lower, meaning I could allow assignment, pay $90 a share for the stock, and then deduct the accumulated net premium collected to date. And after 3 rounds of collecting net premium, my adjusted dividend yield on this dividend aristocrat would have easily been above 6%. Now, that's not a cop-out, by the way, because there's no way I'm not going to repair the trade if I'm being completely honest. But the longer this process plays out, the more tempting it becomes to actually take the shares. But incidentally, this is the key to our very effective trade repair approach. Every time we touch a trade, our cost basis or break even is going lower because we require a net credit on every roll or adjustment and because we're always striving to work the strike price lower on our in-the-money short puts. And sometimes, under specific conditions, when a trade really goes against us, we'll add contracts to the trade and really work the strike price lower, while, you guessed it, picking up additional net premium along the way. But we don't manage a trade by break-even or cost basis. We manage it by strike price. The best way to think about put-selling trade repairs is that the more we're able to work the strike price lower in a trade, the quicker we'll be out of the trade, and the less the stock will have to come back for us. And the more total net premium we accumulate over the life of the campaign, the greater our final profits will be. But I digress a bit because our TROW trade here turned out to be a pretty benign trade repair situation. Still, I wanted to explain why in this situation it made strategic sense to do a straight rollout and only 1 month versus possibly rolling down and out 3 months for a very small net credit. And that's basically because if TROW hadn't recovered within that April expiration cycle, we still might have had a shot to use the upcoming earnings release to roll down and out for a net credit within 3 months by going out to the July expiration at that point. And if not, then as I said earlier, likely another nice net premium haul from a straight rollout. So on March 19th, 1 day ahead of expiration with TROW trading at $86.71 a share, I bought to close my expiring March 20th $90 put for $3.45 a contract, and then I sold to open a TROW April 17, 2026 $90 put for $4.65 a contract, or a $1.20 net credit. After commissions and fees, I collected an additional $116.08 in net premium for a still attractive 16.61% annualized ROI projected over the following 29 days through expiration. That brought the total accumulated net premium over 2 legs to $327.64. And that worked out to be an overall 19.83% annualized rate projected now over 67 days. I also noted in my Leverage Investing Club post and trade alert that we were still benefiting here from the elevated implied volatility levels market-wide. If you recall, for a bit there in March, the VIX was actually trading above 30. And I also had no problems keeping the trade going as it was still producing very attractive returns. And remember, we were dealing with a business that carries no debt, had a dividend yield at this point that was just shy of 6%. And remember, our potential adjusted dividend yield would have been higher than that, and a forward PE of less than 9. So I was very comfortable with the position. Okay, fast forward towards the April expiration or month number 2, and plan A, which was to give the stock along with the rest of the market some time to recover, totally worked out as TROW did rebound quite nicely and easily recaptured that $90 share price level. That means we totally avoided the need to kick the trade out farther in time and be exposed to an earnings release. Obviously, we had no guarantee that this was how things would play out, so we did catch a break. But still, with our decision to just go out 1 month from March to April and give the stock another month to get its act together, we did set things up so that we benefited if that scenario played out. But what I specifically want to focus on here at the end was our decision to exit the trade a couple days before that final expiration rather than allowing the position to simply expire worthless. Because that's what we did. On Wednesday, April 15th, 2 days before expiration, with TROW price now trading at $95.95 a share, we bought to close our expiring April 17th, 2026 $90 short puts for 6 cents a contract. So let's take a moment or two to look at that, even though it was virtually assured that those $90 short puts would expire worthless. Here's the intraday chart I posted inside the club at the time, so you can see what kind of downside buffer we had. But as you can also clearly see, TROW was trading in a previously congested area, which could mean some resistance. Additionally, although this chart here is still early in the trading session, as you can see with the upper wick on that day's candle, shares were giving back their earlier opening gains. So we simply followed some basic put selling principles here, at least how we do it inside the Leverage Investing Club. And that's to sell puts at proven support and buy them back at signs of resistance. The good news, I got a pretty nice fill on my exit order. I believe the ask price was 10 cents a contract, but I was filled for just 6 cents a contract, and that bumped up the final annualized ROI a bit. So with TROW trading at $95.95 a share, I bought to close that April 17th $90 put for 6 cents a contract. The final book gains on the entire campaign were $321.52 on $9,000 of cash secured capital for a really nice 20.06% annualized ROI over 65 days. Finally, just to wrap things up here, and this is fleshed out in more detail in that 12-page downloadable case study I told you about, and you can find the link to that in the description section. But I wanted to quickly go over the top 3 insights that stood out to me with this trade. Key insight number 1, we remained calm and followed our trade management and trade repair principles, i.e. the 4-stage trade repair formula, when the trade initially went against us and TROW drifted lower throughout much of March along with the broader market. As I explained earlier, our primary objective when a short put position trades in the money on us is to work the strike price lower, but only if we can do so efficiently and effectively. So that requires a net credit, and that requires not rolling out more than 3 monthly expiration cycles to get that adjustment lower. And if we can't do that, no big deal. Our trade repair formula says to simply roll straight out for a net credit. Again, 1 to 3 months max. Now, if the stock really sells off so that even rolling straight out at the same strike price only results in a marginal net credit, also not a big deal because we have bigger and more lethal tools in our toolkit to deal with that. The point is, it's nice to have a trade management and trade repair playbook that's proven itself countless times over the long term. And it's nice to be able to trust that playbook and not have to deal with any stress or guesswork. Key insight number 2, despite having a very effective and clear 4-stage trade repair formula, we still take things on a case-by-case basis and make informed decisions. We already covered this, of course, but I really like that strategic decision to only roll out 1 month from March to April and give the stock a chance to basically repair itself so we could avoid the uncertainty of the upcoming earnings release. And that's exactly how things played out. But even if things hadn't worked out so neatly, we still had that earnings release and the related premium boost in our back pocket. This trade really is a good example, by the way, of just how flexible and forgiving option selling can be. And finally, key insight number 3, we adhered to a disciplined trade exit. As I mentioned earlier, the TROW position was far enough out of the money when we exited a couple of trading sessions prior to expiration that there was virtually no risk keeping the trade open and allowing the short puts to expire worthless. But as we also saw in the intraday chart I shared earlier, TROW clearly looked like it was fizzling out in the near term. And when you see that, it's good trade management discipline to consider exiting a winning short put position and locking in whatever gains you have at that point. Because if a stock is running out of gas, stalling, hitting resistance, it's now at an increased risk of reversing in the near term and heading back lower. And in this instance, our early exit had the added benefit of bumping up the final annualized ROI on the trade. We walked away with 20.06% annualized returns over 65 days. Had we held until expiration, and assuming the short puts expired worthless, the final AROI would have been 19.83% over 67 days. Again, with this trade, very little risk of anything going wrong, and as expected, those $90 short puts would have expired worthless as it turned out, but it's still a good idea to maintain principled trade management discipline. Okay, if you enjoyed this and want more option selling resources, be sure to check out the channel's other videos and playlists and subscribe. The channel is really starting to gain traction here, and we recently hit the 1,000 subscriber milestone, and I've got a lot more option trading videos in the works. And as I mentioned, there's also a link below to download the full 12-page case study on today's TROW price trade, so you can check out everything in more detail and keep it as a permanent resource and reference guide. Also, sign up for the Daily Tips newsletter via the pinned comment below. The newsletter is a tremendous option selling resource and really complements the YouTube channel, as some topics are better suited in article format and some are better suited in video format. Both resources are all about hedge you win, tells Mr. Market loses, so the newsletter is a resource you're going to want. You can sign up directly, or there's also a link in the description section below to the Great Option Trading Strategy downloadable library page. Download anything from there, and you'll also begin receiving the Daily Tips newsletter automatically. Or same thing if you download the TROW case study PDF. Hedge you win, tells Mr. Market loses. Let me help you come out ahead on virtually all of your trades. Okay, until next time.